I'd like to welcome our new sponsor, Rothschild Capital Solutions. Rothschild is a commercial investment banker and direct lender. The company targets well-located assets for value-add investment, primarily in the Midwest and the Southeast. Rothschild is positioned to invest up to $35 million per deal. They may be just the partner or lender you've been looking for to turn your deals, even the most aspiring, into reality. Need capitalization beyond a debt financing loan? Rothschild gives you a full set of options: JV equity, bridge, preferred equity, mezzanine, development and construction. What do you need? The chances are Rothschild can provide it, as well as the experts to make the deal real. Click on the banner below the show to contact Gary Williams now. You've got the deal, Gary's got the backing you need. Click now. Hello and welcome back to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. Of course, the big news today is that the race for president of the United States of America continues, with the vote counting state by state coming down to a close race. We will see what happens. Meanwhile, the stock market has rallied. All three of the indices are up and in green on this session. And in fact, they've had the best three-day rally since April. So they are up on the news. We did see the U.S. 10-year Treasury yield spike in between episodes of last week and this week. It has come back down. It was in the 80, trading in the 80 range. Now we're back down, trading to just about where we were last episode. That's at 0.78, 78 basis points today of the 10-year. Boy, I was just looking back at a chart, in January, the 10-year U.S. Treasury yield was just under 2%. Boy, that seems like a long time ago. So we're back down to where we were before the 0.78 range. Crude oil, nice to see that pop up, $2 a barrel. We're now at the $39 barrel range. Jumping over to multifamily interest rates. Again, when the market moves up, the interest rates tend to move up faster. When the market comes back down, it takes a little bit of time. So perhaps volatility, perhaps the move up in the 10-year Treasury yield. We are seeing higher rates a little bit on the FHA side than where they were last week. I do expect to see those come down, but today the 223F is quoting at about 237. That's 2.37, and that's fixed for 35 years. And the 221D4 new construction sub rehab quoting at 2.97. So still has a two handle on it, but it has crept up a little bit since where we were. Again, I do expect to see that settle in, particularly if the U.S. 10-year Treasury yield continues to stay range bound. Jumping on over to the Fannie Mae desk, we're seeing the low end of their 10-year rate at 282, 2.82. That is fixed for 10 years. And on the Freddie Mac, we're seeing that about 310, 3.10. That is fixed for 10 years. Still a very low interest rate environment, folks. And on that note, I actually pulled there was some disclosures from HUD about top lender volume. I'm happy to say the company I work for, Gershman Investment Corp, is number 6. But when you take the top 10 lenders in the country that do HUD loans, they have gotten approvals, which we call firm commitments in our world, of $11.5 billion this year. That is incredible, an incredible amount of volume. And the Southeast region broke down their volume by type of loan. And of course, the refinance purchase program, the 223F program, is leading the pack. That is no big surprise with falling interest rates being what they are and fixing them for the long term. It makes a lot of sense to lock in an FHA loan at these incredibly low interest rates. So no shocker there that refinances are leading the way, but also seeing a substantial amount of new construction loans as well. Jumping on over to the just the markets in general on variable interest rates. Thought I'd just mention that my friend at Walker Dunlop mentioned they are starting to quote the SOFR rate. That is the secured overnight financing rate meant to replace LIBOR, the London Interbank offering rate, at some point. We don't know exactly when, but should be happening. And they are actually starting to quote that SOFR rate. So looking at their chart on that, it is trading just under the 1-month LIBOR, which is what it is meant to replace. And if you go back and watch my Money Talks episode with Winston Crowley from UMB, that's exactly what he said. He said that the SOFR is going to be mechanized so that there is not a disruption to the market and that the index parallels where LIBOR is at, and hopefully it will be more stable over time. So last thing I want to mention to you today, again, talking about the volume of HUD FHA refinances, the 223F program. If you're a HUD borrower, or if you want to become a HUD borrower, here's something to consider before you apply for a loan. Get your physical capital needs assessment, your PCNA, get that completed before you submit the loan. Now, why would you do this? You have to do this anyway in the firm commitment process, but do it early in the process, and here's why. You want to figure out what, if any, are the non-critical repairs in that report, and if you have the capacity to do so, make those repairs. The reason for that is there is an additional escrow multiplier due to COVID. So HUD is taking an extra insurance policy, if you will, to make sure that repairs get completed. But the multiplier they're using is 250%. So for every dollar of non-critical repairs, you have to reserve an additional $2.50. So if you have the capacity, make the repairs rather than having to escrow a much larger amount than is needed to make the repairs. That's just my tip for this week, something I've been talking with borrowers about today, and I thought that may be helpful to you. I wish you all well, and please, thank you for tuning in. Come back and see me next time for another exciting edition of Rate Desk. I'm your host, Michael Thomas, signing off.